Broadcasting from Baltimore, Maryland, and all around the world, you're listening to the Stansberry Investor Hour. Tune in each Thursday on iTunes for the latest episodes of the Stansberry Investor Hour. Sign up for the free show archive at investorhour.com. Here is your host, Dan Ferris.
Hello and welcome to another episode of the Stansberry Investor Hour. I'm your host, Dan Ferris. I'm the editor of Extreme Value, a value investing newsletter published by Stansberry. We have a great show lined up for you today, so let's just get right into it. Okay, it's time, of course, for the weekly rant. Now look, last week in the rant, I said saving money is the master skill for investors, right? I said it was a negative skill. It's what you don't do, you don't spend, that counts. And this week, I want to read you, because last week I remember I said this whole business about a negative skill was something I learned from Nassim Taleb, the author of The Black Swan and Fooled by Randomness and Anti-Fragile and Skin in the Game. He also wrote another book called The Bed of Procrustes, Philosophical and Practical Aphorisms. And it's a great little book, and it's got it's got a whole chapter called Epistemology and Subtractive Knowledge. So subtractive knowledge, of course, is this idea that, learning is about eliminating error. It's that negative thing we talked about. And I just want to read you a really, really great quote that kind of sums up what I meant. He says, most people think intelligence is about noticing things that are relevant, detecting patterns. In a complex world, intelligence consists in ignoring things that are irrelevant, avoiding false patterns. Not being fooled by randomness, I think he might even say. So that's what I was talking about last week. This week, I want to go a step further and talk about what you do after you accumulate capital, okay? So this week's rant is really about the difference between investment and speculation. That's what we're going to talk about. Okay, so those are the two basic types of financial activity. Once you build up capital, what you going to do with it, man? You got to do something. If you just let it sit there, it's probably going to lose purchasing power over time. So you have to do something. And of course, I would say the something you have to do is avoid all the somethings that you shouldn't do, and that'll leave you with a few great ideas. Okay, so if you don't really understand the difference between speculation and investing, if you haven't spent time thinking about this, I would suggest before you buy another stock, bond, option, futures contract, ETF, anything, that you had better learn the difference between speculation and investment. And in fact, I bet most people who think they call themselves investors, I bet you most of them are speculators. And that's really bad, because it means that you're taking a lot more risk than you think you're taking. And your results over time will come to reflect that. And if you get lucky in the beginning, that's even worse, because you think you got it nailed. And in the end, you wind up losing because, the bad trades always come back to get you, and the weak strategy always comes back to get you. And you'll lose money instead of making it. You'll destroy capital instead of protecting it. We want to help you make it. We want to help you protect it. So let's look at a quick definition of investing versus speculation. This is from Security Analysis by Ben Graham, like the Bible of, really the Bible of, not just the Bible of value investing, the Bible of security analysis, as we have come to know it. It's published in 1934. The first time. There's 6 editions. Graham says, he spends a whole chapter actually talking about the difference between investment and speculation. It's that important, okay? And he acknowledges all the difficulties of making a distinction once you really start trying to nail it down. But then he arrives at the following definition. Quote, an investment operation is one which, upon thorough analysis, promises safety of principal and a satisfactory return. Operations not meeting these requirements are speculative. End quote. Now you notice a couple of things right away. He's not saying speculation is bad. Speculation can be done well. I'm not a value dogmatist, okay? There's more than one way to skin a cat. But notice something else. There's three things here: thorough analysis, safety of principle, satisfactory return. Okay? Safety of principle is really the only truly objective one, right? Your principle is like if you buy a bond and you buy a $10,000 bond. $10,000 is your principal, and whatever interest rate you get is the interest that you earn. Well, it's the same thing with all investing. Your principal is whatever you put in, and your return is whatever you get out of it. But even that objective criteria, upon closer inspection, that safety of principle, that kind of gives way. How safe? How safe is safe? How safe is safe enough? I don't know. So it's all subjective, and it requires your judgment. All right, so with these three items in mind, let's stop being abstract and let's just take a bunch of examples and see what we can see about them. We'll take the first one, Tesla. And my question for you, dear listener, is this: is it even possible to be an investor, to make an investment in Tesla shares? Okay, well, let's see. What are our three things for investment? Thorough analysis, check. You can do thorough analysis on Tesla. Safety of principle and a satisfactory return. Okay, well, we run into a problem there, don't we? Why do we run into a problem with safety of principle and satisfactory return with Tesla? Here's the problem. It's a brand new company, still relatively new. It doesn't make money. It burns cash. The business model has yet to be proven. So you don't really know what you're getting with Tesla, do you? You don't know. It's just a pure speculation any way you look at it. In my opinion, this is my opinion. If you disagree, write in. Right? feedback@investorhour.com. But I would say that in the example of Tesla, it is at this stage of the game impossible to make an investment. You can only be speculating if you own Tesla shares. Next example, other end of the spectrum, Berkshire Hathaway. Is it possible to do thorough analysis, get safety of principle and a satisfactory return? I think it is. You can definitely do thorough analysis. They, of course, report, they send out this annual letter that's like one of the best annual letters of any public company. They tell you how to think about the value of the business, how to think about the intrinsic value. And, they tell you their philosophy and a bit about their process, the investments they make and how they make them. And they generally do a better job at running a public company than most people. And you can get safety of principle and a satisfactory return because it generates a pretty regular stream of cash flow, free cash flow in excess of all expenses and taxes and capital requirements to keep the business running and growing. So I would say that it is possible to make an investment in Berkshire Hathaway. Can you speculate in Berkshire Hathaway? Well, sure you can. You can place a bet on the stock going up over some period of time. You can say, I think it's going to go up 10%. Boom, I'm going to buy it. And if it doesn't go up 10% during that time, maybe you're flat, or maybe you made less than 10%, or maybe you lost 10% or something. Okay, let's move on to a couple more examples. How about like Amazon, the FANG stocks, Facebook, Amazon, Apple, Google, Netflix is one of the FANG stocks, but I'm going to leave that one out. Facebook, Amazon, Apple, Google. Is it possible to invest? Well, from my previous example of Berkshire Hathaway, yeah, it sure is, right? Because they make cash profits. So you can figure out, at least you can do some basic work to figure out if you think this cash flow stream is durable, and if you think the business model is going to be here in 5 or 10 years or more, and if you think they're going to maintain their margins, and all those other decisions you have to make. It is possible to invest. Now with Amazon, it tends to trade at like 40 or 50 times all the profit it's ever made in its entire history. So that's another question. Is it possible for an investment in Amazon to take place at this valuation? For me, it's not. For you, it might be. It's subjective, right? More examples. How about Kraft Heinz? Right? Ticker symbol KHC, Kraft Heinz? Yeah. So, Kraft cheeses and things and Heinz ketchup and all that. Is it possible to make an investment in this? Well, Warren Buffett owns 27% of the company, so I'm going to say yes. But for me, it's extremely difficult to think about investing in this because, and we'll cover this in What's New today, in the What's New segment a little later on, but that industry is under assault. Technology has made things a lot different, and I've talked about this before. Just one basic thing with consumer packaged goods companies, and I think the same thing applies to like AB InBev and other companies. Advertising is not scarce the way it used to be. It used to be you could reach a huge audience because everybody was plugged into their TV every night. Things are different now. People don't watch, they don't necessarily watch TV on TV. They can get all kinds of stuff online. They can watch YouTube, for goodness sake. So the margins in that industry are going to come down because you can't have that intangible brand power the way you used to. It's different. And I would say it's possible to invest in KHC. It's had regular cash flows over time, but there's something in that industry that makes it really super difficult. And I'm not even sure that I could say that it's possible for me to make a real true investment in that. Not at current valuations. I think it has to come down a long way because of the destruction happening in consumer packaged goods. Okay, what about publicly traded banks? They're not investable for me, and I'll tell you why. You can speculate on all this stuff, right? But publicly traded banks, most of them, the overwhelming majority of them, are not investable because the loans are made and underwritten in a black box. They don't really tell me enough about what they're doing. They tell me what they've done. They tell you, the percentage of loans that aren't performing and all of that things, but that's all historical. I need to understand what type of loans are being made. Now, I suppose if you really wanted to, you could kind of tail their loan officers around, and find out who they're lending money to. And, you can get a general idea. Some of them will tell you a general idea. Well, some of them are, loans to, their mortgage loans for homes, their business loans, auto loans, whatever they are. They'll give you some information. But by and large, I have found that the underwriting is just too much in a black box for most publicly traded banks to be investable for me. Okay, what about sovereign bonds trading at negative yields? Sovereign bonds, the debt of many of the biggest and most creditworthy countries in the world, countries like Switzerland and Germany and Japan, trading at negative yields. So if you buy them today, you're guaranteed to lose money. That doesn't meet the criteria, does it? Because your safety of principle is not there. You can do lots of thorough analysis, but you can't get safety of principle, and you can't get anything like an adequate return. Sovereign bonds are speculative instruments. I would say they're toxic waste when they're trading at negative yields. What about Bitcoin? Can you invest in Bitcoin? I frankly have no idea. There's no cash flow associated with it. It's just an asset that kind of gets traded. It's like, it's just like a commodity that gets traded. Can you invest in a bushel of wheat? I don't know. You can bet on the price movement, but can you ever get safety of principle? Can you ever do enough thorough analysis on Bitcoin to get safety of principle and an adequate return? No. It can only be a speculation. What about physical gold? You buy a bar of gold. Can you get safety of principle? I think over the long term, you've actually done okay with that. You've preserved some purchasing power. But you might not get an adequate return. You can do thorough analysis, I suppose, on gold, um, but an adequate return, satisfactory return, I don't think so. I think when you're buying physical gold, it's the best way to buy it is the belief that it provides disaster insurance. It's never an investment per se. You see? I hope you see where we're getting here. Investment is a very specific thing, and it's probably a much smaller subset of anything in the publicly traded markets or anywhere else that you ever thought. What about income-producing real estate? Provided you're getting enough yield off of it, and you do enough thorough analysis, you can get safety of principal, I believe, and you can get, because you can insure real estate, right? Safety of principal, and you can buy it at a price that'll get you a satisfactory return. So I hope these examples and this idea that speculation is different from investment means something to you, because you need to know every time you put money into anything, any stock, bond, future option, anything, you had better understand whether or not you are investing and have safety of principal and an adequate return, or whether you're speculating. And if you're speculating, hey, that's okay, as long as you understand the risks of what you're doing. All right, that's this week's rant. Maybe you agree, maybe you disagree, maybe you think I'm all wet, maybe you think I'm a complete idiot. Of course, if you think I'm a complete idiot and you write in, what am I going to do? I'm going to delete your email. But write in at feedback@investorhour.com. That's the rant. All right, let's get on to the What's New segment. Let's find out what's new in the world today. And the first thing that's new is the date. You know what today is? Well, today is actually March the 7th, 2019, but yesterday was March the 6th, 2019. March the 6th. I hope that's ringing some bells. March the 6th was the bottom in 2009. That was the bottom of the financial crisis, with the S&P 500 down 58%, as I recall. And it bottomed out at 666, prompting all manner of speculation into, divine retribution for all the bizarre financial activity that preceded that moment. 2009 was the last year I recommended stocks at a pace of at least one per month. In 2012, I think we recommended 3 new long positions. In 2015, 2 new long positions. It's been a horrendous decade for value investors. But I think it's about to be a really good one over the next 10 years. So fingers crossed, right? We're 10 years off the bottom. It's horrendous for value investors. All kinds of speculative nonsense is taking place. Equity valuations are near their highest levels in history, which were reached back in September 2018, and we're just within a few percent of that once again. So, we'll see how all this works out. It's usually not good, but I still maintain that you should buy value when and where you find it. Okay, here's another interesting bit of news. This, there's an article in something called BrazilJournal.com, and this was forwarded to me by friend and colleague Whitney Tilson. And it's all about 4 pieces of advice it's called Enrique Abeta has 4 pieces of advice for Jorge Paulo Lemann. Jorge Paulo Lemann is the head of a company called 3G. This is the company that's taken over AB InBev and Kraft Heinz, and it levered them up and cut costs and did all kinds of things. And not too long ago, Jorge Lemann came out and said that he's terrified at what's happening in these industries he never anticipated. He thought these would be wonderful businesses forever, and of course, as we discussed in the weekly rant, Kraft Heinz and AB InBev are kind of under attack. They're being disrupted in an age of technology where advertising is not cheap, and and you can do all kinds of things that you couldn't do before, and their business models are under attack. So, but this article in Brazil Journal has 4 pieces of advice for Jorge Paulo Lemann, who controls these big companies. Piece of advice number 1 is, you're screwed, accept it. Number 2, he says, create a specific purpose vehicle. Apparently this is some sort of a accounting or legal convention that would set aside some amount of capital legally from his other firm. And he said, create a specific purpose vehicle and bet on the downfall of your competitors' stocks. At least take some advantage. In other words, you should be short all the stuff that you're currently long in a big fat levered way. Number 3, create a $1 billion venture fund and embrace disruption radically. The next $20 billion brand will come out of there. And I believe that could be true, because these guys, they've made a little mistake, or a giant mistake, but a little mistake with a lot of money. But they know brands, and they're very good businessmen at 3G, and that's actually a really good piece of advice. Number 4, finally, start selling your assets. Transfer your problems to others. And this guy, Enrique Abeta, I saw him give a presentation last year. It was our friend and colleague Whitney Tilson held a short selling conference in New York, and I went up there, and Abeta stood in front of the audience and said, you should short Kraft Heinz, Anheuser-Busch, and Disney, he added to the list. Not sure if I agree with that one, but definitely the other 2. He said, I would be short all 3 of these stocks in good size. The wave of digitally enabled disruptors will humble these industry giants, he says. And sure enough, of course, Kraft Heinz was down like 28% recently in one day. And, AB InBev was like well above $100, and now it's below. So, interesting stuff. Companies to avoid, I would suggest. And a whole slew of companies, consumer packaged goods, to be careful of. One more piece of news here, also forwarded by friend and colleague Whitney Tilson. Or Whitney figures into this, okay? So Tesla had a really bad time recently. Elon Musk, founder, came out and said they're going to close most of their stores and shift to online-only sales. Okay, well, here we are, early March. February 19th, he said brick-and-mortar retail strategy was important to the company. He changed his mind. He got new information and changed his mind. And a lot of the sales personnel didn't even find out about this decision until it was published on a public blog last week. And our friend Whitney Tilson says on Friday, when some of these announcements were made, he says that was it. That was the turning point, and the stock is going to finish the year out at under $100. And Whitney's had a reasonable time. I mean, he called the top of Bitcoin not to the month or the week or even the day, but to the hour. Maybe a year and some ago, a year and a couple months ago. So, and he's made a couple other big calls like that, and he was one of the early voices saying, the financial crisis is coming and this is going to be really bad. So, like any good value investor, I've done a bit of this sort of thing successfully myself. Like any good value investor, he's looking at risk, and he understands at least as much as what we said in the weekly rant, that Tesla's a pure speculation. It's an unproven business model that is struggling badly. The demand is weak for their cars, competition coming out of the woodwork, et cetera, and Musk is just kind of weird, and he makes, fraudulent or nearly fraudulent statements on Twitter. It's just not a good situation. It's not investable. And one more little item. Target shares have surged, and because the company beat Wall Street earnings estimates. And so, this is, it's good for Target. The sales at, the comp sales at stores open for at least 12 months, what they call comp sales in retail, we're up 5.3% from the prior year. That's a great number. They haven't had great numbers in that respect over the past couple of years, but that's a pretty great one. Digital sales surged more than 25% for the fifth year in a row, but net income slid 26.5%. Here's the thing. You remember a story Warren Buffett used to tell about retail? He said, I think he owned a stake in a company that was based in Baltimore where I grew up. Once upon a time, he owned a stake in E.J. Corvettes, I think it was. It was either E.J. Corvette or Hochschild Kohn, two big retailers that were in Baltimore when I was growing up. And he says, he was talking about being in that business. He said, no matter what my competitor does, I have to do it or I'm immediately irrelevant. It's just highly, highly competitive. You don't have much control over pricing. Yay for Target. They've had some good success. But this thing about the digital sales surging, well, they had better surge, hadn't they? If you want to keep pace in a world dominated by Amazon. So, when I see news like this, I go, yeah, but things are still really tough and getting tougher all the time. All right, that's what's new. Now it is time to talk to our guest. I'm really excited for the interview this week with our guest, Chris Mayer, friend and colleague. Just note that Chris is on Skype, so he might be a little Skypey sounding. But this should go really well. I'm really looking forward to talking to him. So after 11 years with Agora Financial, Chris Mayer joined Bonner & Partners to develop a first-of-its-kind investment advisory, the Bonner Private Portfolio. This is the only trading service ever to be actively followed by Bill Bonner. In fact, Bill's family trust is committed to invest $5 million in Chris's model portfolio. And Bill Bonner was the guy who hired me way back in 1997 off the street, knowing little about me. He's the sort of father of all these companies, of which Stansberry Research is one, under the Agora umbrella. So Chris's latest project is called Chris Mayer's Focus. It provides an in-depth hedge fund quality analysis on a select group of small-cap stocks with the potential to become the next Starbucks, Walmart, or Berkshire Hathaway. Chris has been a guest on Forbes on Fox, Fox Business, CNN Radio, Russia Today TV, multiple appearances on CNBC and radio. And Chris is quite the accomplished author. His first book, Invest Like a Dealmaker, Secrets from a Former Banking Insider, covers time-tested essential principles of investing. His newest book is called 100 Baggers, Stocks that Return 100 to 1 and How to Find Them. Teaches readers all the key characteristics of companies that return $100 for every $1 invested. After 2 decades of investing, Chris developed a proprietary code system. That's CODE, and we'll get into what that means. And he used this to outperform not only the S&P 500, but also legendary investors like Warren Buffett, Carl Icahn, John Paulson, David Einhorn for 10 years straight. Chris is now the co-founder and portfolio manager of the Woodlock House Family Capital Fund. Ladies and gentlemen, please welcome, I haven't talked to him in years, my friend and colleague, Chris Mayer. Chris, welcome to the program.
Hey, Dan. Thanks for having me on.
Boy, that was some introduction. I guess you're in the right place.
That was.
So, Chris...
It's going to be hard to live up to now.
Well, I know you'll do your best. So it's been a while since we talked. And you've been busy. So, but before we go on, and talk about like the Woodlock Family House Family Capital Fund and Chris Mayer's Focus, can you tell people about this code system, because I think it's quite a brilliant little screen that you've developed.
Sure. So let me first say that I'm working at Woodlock House Family Capital, which I guess we'll talk about in a bit. But I no longer write those newsletters. They are in other capable hands.
Okay.
Actually, the focus letter continues, that the private portfolio has been folded. So that's out there.
Okay.
So let's look at code. So code, is an acronym to sum up some of the key things I look for in an investment, and it's really simple. So C stands for cheap, which we both share, looking for stocks that we can say we think are undervalued in some way. O is for owner operators, which is, or ownership more broadly, which is I'm looking for stocks where the people in control have skin in the game. And the best way is ownership in the company itself. And D is for disclosures, which as an outside passive minority investor, I rely heavily on public disclosures, so those have to be fairly clean and in a business that I can understand. And then the last thing is E is for excellent financial condition. This just means that I'm not knowingly taking on a balance sheet risk if I can help it. I'm not buying companies that have an excessive amount of debt. And so in combination, these are 4 important things that I look for.
They all sound like sources of downside protection to me. Is that accurate?
Yeah, I'd say it's all very defensive. So all those things are. In fact, I was talking to a friend of mine the other day who manages money, and we were talking about, well, what's the first question that you ask yourself when you look at a stock? And for me, it's, am I going to lose money? And that's really the first thing. I don't care owning a stock, and if it doesn't go anywhere for a year or 2 or 3, that's okay. I just want to have the odds of what we call permanent impairment being very low. So permanent impairment being, of course, money that you can't get back. Prices fluctuate, they go up and down. But what are the odds of you owning something over a 2 or 3 or 4 year period and actually losing money on it? I want that to be as low as possible. And all these 4 things work to protect that downside. So you're absolutely right.
Yeah, so it's almost, we talked about negative action and negative advice and things in the program last week and this week. And it sounds like you've developed a system of negative advice, what to avoid, because a lot of public companies don't fit the code, right?
That's right. Yes, and so that's good and bad. It's obviously it works as a very good filter, and it's always interesting to see, there's always lots of cheap stocks out there, but there are very few cheap stocks that are then also have no leverage and also have a lot of insiders, and those in particular I find being the ones that are tough to find.
Yeah, your universe must be. You obviously you must look for companies just all over the world in all different markets, I assume, right?
That's right. So yeah, all over the world. As a practical matter, because disclosures and all, I'm confined to the larger markets in Western Europe, for example, and there are companies on Japan that have very good disclosures. But when I say I'm all over the world, it doesn't necessarily mean I'm investing in the Malaysian Stock Exchange or Singapore or something like that.
I see. Now, Chris, we've known each other a long time. I was wondering, I started in this newsletter game in 1997, and you started not too long after that. Isn't that right?
That's right. I started in 2004, and you remember that year, I think it was that year, where you and I took that trip to Bermuda and did the little investigation on the reinsurers.
Yeah, that was a very interesting trip. I learned that reinsurance is an extremely difficult thing to invest in. I'm not sure.
That's what I think we learned. We learned that, and we learned that they have pretty good fish stew in Bermuda. I think that was our 2 main lessons from that investment trip.
Yeah, the fish stew was excellent. But those reinsurers, they don't go to Bermuda because they want everyone to know exactly what they're doing, right? That's the first thing we learned.
That's right.
I've also learned over the years that this is kind of an inside joke between Chris and I, everybody. It seems like Chris has done extraordinarily well over the long term, and I've actually done pretty well too. But when Chris and I have agreed on a particular stock, look the hell out below. I'm not kidding. Isn't that true? It's crazy.
No, that's true. It's somehow, for whatever reason, when we both like a stock, it almost never works out. I don't know what it is, but
yeah,
it has happened, seems like an awful lot. I don't know why.
Yeah, I think, realistically speaking, I think it happened like 2 or 3 times, but, that was enough to just like jinx the hell out of it, I guess. I remember one company was it was loaded up with, what was it, Railcar America, I think it was called? Just loaded up with cash. Like, how could this possibly go wrong? Loaded up with cash, no debt. And I don't know where you exited, but I think I was down about 20 or 30% when I finally threw the towel on that one.
Yes, that's right. I vaguely remember that one as well. I think part of that was we had just gotten the cycle wrong. And so I think it went against us. There was more money lost. And, we took our hits on that one.
Right. And so you mentioned cycles, which I'll tell you something, they've come to mean a heck of a lot to me. Do you where do cycles play a role in your your code system or just your overall investment philosophy?
Yeah, that's a good question. It's something I've thought a lot about as far as building this portfolio as well. And ideally, we wouldn't own any of those sort of deeply cyclical names. We'd own stocks that are in great businesses that are going to go up 15% every year. But of course, there aren't a lot of those. And so I have some portion of the portfolio where it's a small part of the portfolio where I'm willing to go into some of the more cyclical names. Energy right now is beat up to hell, and there's some interesting things to do there. And even in shipping, there's a couple of things that I think maybe are interesting there. So I definitely pay attention to industry cycles. And when things get frothy on an industry, or multiples are historically high, or actually in some cases, when the cyclical industry is doing well, all the PEs are low. But these are things I try to avoid as much as possible, those sorts of cyclical peaks. And again, ideally, I'd rather just own something like a McDonald's or a Coke. Not that I own those, but I'm just using those as examples of businesses that are generally not that cyclical and have grown well over time. But you got to do other things. So yeah, I mean, otherwise the big macro cycles, I tend to discount more because those are so incredibly difficult to get right, as you know.
Yeah, they're crazy hard to get right. I just realized I don't think I've ever heard you once talk about, is the stock market, the S&P 500 or something like that, too expensive, or, is this a generally difficult, maybe you've talked about a difficult time to find bargains, but that's the closest, I think, correct me if I'm wrong, to ever hearing you make, what might be called macro-oriented comments. To me, I think of you as the quintessential bottom-up guy. Is that right? I mean, that's the way I've always thought of you.
Yeah, no, I think that's fair. I made a point of that too, even when I was writing my newsletters all those years, that I wouldn't do that I wouldn't comment on the overall market or necessarily say it's expensive or cheap or whatever. And part of that, as I always tell people, is that I'm not buying the S&P 500. So the S&P 500's valuation doesn't necessarily interest me so much.
Mm-hmm.
And there's a lot of interesting things about that. When people think about the S&P 500, they often think they're getting a big diversified list of companies, but as you and I know, the weight of returns has really been driven by a handful of stocks in the S&P 500. And I think last year there was a point where something like half of the S&P 500's return was 5 stocks. So most of the things I tend to invest in are not in the S&P 500. And they can even be, as we talked about before, in different markets overseas. So it's less relevant for my approach.
Okay, so I don't want to let the cat out of the bag here, but maybe I'll let you, if you choose to let the cat out of the bag. Is there a specific name that you kind of like lately that kind of, it may not even be something that you're buying right now, but just like a concrete example of something that fits the code and doesn't have these, hyper cyclical characteristics that you sort of don't like and stay away from? Is there like a quintessential name that you've bought in the past, or maybe even own now or have bought recently, that you wish to share with us?
Yeah, I mean, so let's see. I think a good example of that might be something, let's say Interactive Brokers is a stock that I've recommended in the past, owned in the past, owned presently. And that is an example of a company that fits that code metric, or has in the past. At least as the insider, as far as the ownership goes, Thomas Petterfy is the founder. He's no longer CEO. He recently stepped down, but he's the chairman, and he owns a bunch of stock. He owns most of it, more than half. And balance sheet's always been excellent in Interactive Brokers. This is just an online broker, so it's a simple business. Their balance sheet, they've always had excess capital, no debt. And the disclosures at Interactive Brokers are fantastic, among the best of any company I follow. Every month they put out metrics for their business. You can see how they're doing as far as getting customer accounts and their daily revenue trades and all sorts of things. And the price at different times, so this is one where it doesn't typically look classically cheap. I think if you can pay something around 20 times earnings, you're getting a good deal because, again, that excess capital. And it's a really good business that has grown and grown and grown and grown. So this is a business that generates 60% plus profit margins. And
wow.
Net revenues last year were up more than almost 30% from the year before. So you're getting good growth, very high margins. And that business should trade it at that kind of multiple. And I think that's a business that you can buy and sit on, and it's not overly cyclical. I mean, you might think it's cyclical because, it is a broker. And so when the market goes down and people lose money, it could hurt Interactive Brokers. But Interactive Brokers tends to make more money the more people trade, and when we have a lot more volatility like we've had recently, there's a lot more trading. But irrespective of that, I just think long term, this is a business you could say, I think with great confidence, that it's going to be a lot bigger 5 years from today. And even if the multiple doesn't change or even comes down some, you'll do very, very well.
Well, if you're looking out 5 years, I understand why you're not writing newsletters anymore. But but let me. You mentioned the a higher multiple, and then you said, but that makes sense with the excess capital. I wonder if you could explain that for our listeners.
Sure. Yeah. So I see a lot of times different businesses. People will say, well, this one trades at, let's say, 20 times earnings, and it compares to competitors that trade at 22 or 18 or whatever, but they often neglect the balance sheet aspect of that. So a company can have a lot of debt, and in which case, let's just say all things being equal, you'd probably rather pay the higher PE for a company that's got no debt versus a company that's got a lot of debt. At least I would, because again, I'm being uber defensive about that, and I prefer to have companies with no debt. I don't know that I'm explaining it very well, Dan. I mean, maybe you can help a little out there too.
Well, it's just that when the way I think of it is in terms of enterprise value. So if you take out net cash, you get at the multiple the market is assigning to the actual business. But I think one of the interesting things here about excess capital, especially in a financial name, you see some people complaining about this and saying it's fallow capital. It should be, you should buy back the stock or do something with it or lever up or something. But you don't seem to think they should do that at all. And I agree with you.
Two things about that I'll say. First, your example with enterprise value makes me think of the classic example I always use with people when I talk about this is I'll say, think about your house. If you have a house with a mortgage on it, and think about if you were only quoted the price of the equity and said, well, that house is worth that, and you forgot about the mortgage. And that's what people do when they're just looking at PE analysis, is they're just focusing on the equity and they're ignoring the other piece. And depending, that could be very, very significant. And then, I hear that all the time as well. In fact, it's a lot of times with the companies I have, because they have excess capital, they're carrying around a little extra. They get this pressure. I don't know if it's really pressure, but I guess you'd call it pressure from sell-side analysts and others that want them to do something with that excess cash, either pay it out or lever up somehow. And, I understand why people want to do that, because obviously if you run a very tight ship that way, it tends to help your equity return, but you sacrifice some safety. And for me, I'd rather give up a little of the upside and make sure that I'm in a business that's going to be around and doesn't have to raise capital at an inopportune time. And that's how I would prefer to be. Again, some of this is personal taste. I know people have done very well and they only invest in fairly leveraged equities, but that's not my game.
Nor mine usually. And the neat thing about insisting on, the ownership in code for me is with a name like this, no one's going to get control and force them to lever up. And so you have some continuity. If you trust the behavior, if you know management well enough, they have enough ownership to throw their weight around. And if they're good actors, if they're people who behave well, you could really have something that I agree would be a great investment for a very long time. So it all interconnects, doesn't it?
Yeah, it all interconnects. I mean, one of the things that usually about owners is that they're able to take a longer term view for exactly the reason you just said. He doesn't have to worry about his job. And so he can make decisions that are good for the business long term that may not necessarily be good for the next quarter or two. Whereas a management team that's more of a hired gun don't have that ownership mentality, aren't going to do that. And it comes out in other ways too. I've obviously read a lot of research on this. I mean, the companies that have higher insider ownership tend to be less levered than companies that do not have that owner. And of course, it's tougher to dislodge them. So that's, for some people, can be a downside. You're not likely going to wake up one morning and find out Interactive Brokers has been taken over unless Pederfy okays it. So things like hostile takeovers are less likely to happen. But over the long term, there's a lot of research on this, and it cuts various ways. You can look at insider ownership. I've seen studies that focus on just the CEO. I've seen insider studies that focus more on collectively on the insiders. I've seen studies that focus on family. There's a number of family-owned companies where a family owns a large percentage of stock. And in all these cases, there's outperformance against their peers.
Wow. In all those cases, that's pretty cool. Yeah, it's funny. Mm-hmm. I started thinking about, that we were going to talk today. Late last night, I was kind of fading off to sleep, and I thought I should just sit down and look at who owns the shares for every public company I might have an interest in. Because I agree with you, I did a little bit on the program a couple weeks ago where I said most people, when they're looking at a stock, they look at the recent performance, and if they're thinking about, then they'll think about the process maybe through which the business achieved that, and then maybe they'll think about, the philosophy behind the business, and then maybe they'll think about the people running it. Whereas you ought to do it in reverse, right? You ought to think about the people, their philosophy of business, the process through which they execute, and then the performance which it has garnered and may garner in the future. And I feel like your system is kind of set up to take all that in the right order.
Yeah, I always tell people, I say investing is a people business. And I think that may be the most important thing. There are always exceptions, but in my experience of doing this over a long period of time, when you get burned, even if you've got a great setup and a great stock, it's and a management team that does something self-dealing or stupid, and those things are painful. So I think you stick with people who are winners, who have a good philosophy of business that you agree with, and you marry that with some of these other things. I just think you increase your odds. I mean, all of investing, as you know, is mostly kind of educated guesswork. You can never know everything. And even if you did, it might not help you because you couldn't predict the future, even if you could find out and know everything about a company. So there's just a lot of unknowns we deal with. And the way I look at it is I just want to try to get as many factors I can to improve my odds. And over time, hopefully, that will come out in the results.
All right. So I know let's use this little template. I know you. I've known you for a long time, and we've learned something about your philosophy. What about the process? I know you talked about the code system, But maybe tell us a little bit more about the process that you use in the Woodlock House Family Capital Fund. Are you alone? Do you have analysts working for you? What do you use Bloomberg screens? Can you give us a little more concrete feel of what Chris Mayer does every day to find these rare code system companies?
So yeah, I'm alone, but I feel like I have a very good network and resources that I can tap into. So that was one of the good things about writing a newsletter all those years, is just meeting tons of people. So I know a lot of fellow money managers, fellow investors with similar philosophies. I can tap into the vast network of Agora and all their research capabilities all over the place, and other contacts and that I've made over time, companies I've visited. So there's a long list of companies that I know something about. So I don't rely on screens as much anymore as I did before. Mostly I just read, and interesting things may crop up. I'll look for some interesting filings that come up if somebody's going to sell something, a subsidiary, or if there's a buyback or an insider buy, or these are things that might prompt me to take a look at something. But otherwise, I spend most of my day reading, and then I still do a fair amount of travel. I'll go to conferences or visit the company or go to their annual meeting, which is something I'm looking forward to doing more of, and get to know some of these companies even better. And so a typical day is, you read in the morning, do a little research. In the afternoon, I reserve for emails and phone calls and things like that usually. And I don't use, you mentioned Bloomberg, I use something called Sentio, which is similar. Then I get all my data through that. I have set up on all kinds of alerts. So anytime a company I own or follow makes any kind of filing, I get a little pop-up notice every day in email and on my phone. So that's how I stay connected to the things that are going on. And that's basically the setup.
That sounds like a well-oiled machine and one guy doing it all. It's amazing. I'm suddenly jealous.
Yeah, and I also think I've thought a lot about this, whether it'd be good to have analysts, or whether it's better to be one-man shop. And I guess there are definite advantages to being a one-man shop. One thing is that I look at everything, so I have to do all the work myself and get to know everything pretty well. But it also suits my approach because I'm not out there trading in and out of stocks a lot. I don't need a lot of ideas. And what I've told investors in the fund is I'm looking for 10 to 20, and I think right now they're about 15. And I feel like that's enough. And that 15 comes out, almost most of those names came out of the Bonner private portfolio that I used to run. And then there's some names out of my personal account that are dumped in there. Now I don't have a personal account, it's just in the fund. And so, then I'm just sitting and researching and thinking. The way I think about it is I only need really one, maybe two good ideas a year, and that's it. So it's not even like I'm publishing an issue every month. I don't even have to worry about that. So all I got to do is just sit around, think, be patient, and wait for those one or two great ideas a year. And that's the way I'm kind of thinking about it.
That is epic. You sound like Warren Buffett. It's hard to do, though, isn't it? It's hard to not do anything. How in the world do you not?
Oh, it's very hard. And you know what? I'll be honest. When I started the fund, I couldn't pull my way away from the computer screen for the first at least few weeks. And I knew it was bad habit. I knew I shouldn't do it. But man, it was hard. So I think finally, it's because it was new, I suppose. But finally now I've sort of settled in. So I don't sit there in front of my computer screen and watch every tick. But you're absolutely right. I mean, that is the hard part, is to feel enormous pressure to do something. And of course, as you know, investing is best when you do very little. And so I'm constantly trying to find ways to continue to keep myself focused and thinking long term. Of course, the structure helps a lot because in this particular fund, Bill Bonner put in, well, he's got most of the fund assets are his money, and I know he's not going to pull it out, and it's my money is in there too. So it's almost like having quasi-permanent capital. I can think long term because I don't have to worry about if I have a bad quarter or two. Bill Bonner is not going to say, "Hey, I'm going to take some money out." He's a very, very patient investor himself, and he buys and holds and for keeps, and so it fits very well with the philosophy of the fund.
Yeah, fund managers, boy, I dabbled in this back in 2007, 2010 time frame, which was really brutal. But I did okay considering, yeah. But you quickly learn that, basically what you just said, you quickly learn that if you don't have an investor, a limited partner or whatever you want to call them, who understands it just about as well as you do, and understands that you're in this thing and that nothing works every year or even every 2 or 3 years, you're screwed. You're going to get a call one day that's going to ruin your business. And I never got that call, but I never attracted more than like $1 million either. So that's not a business. So I said, maybe this isn't for me. $1 million of other people's money.
I mean, that's it. That's the difficult part. You want to make sure your partners are people who buy into it. And I've been lucky because the outside partners we've taken have all been readers who've known me for a very long time. And so I feel 100% confident and comfortable having them there. And then I'm not going to get that phone call that says, when things go rough. So we'll see. But so far, I like it. It's exciting. And I think I got it set up really the way I wanted to. I mean, all those years when I was managing newsletters, I, of course, had opportunities to manage money before. I have had offers. But it was never the right situation, never the right structure. It was always something I didn't like about it, either because it was a monthly, quarterly reporting type thing, or the partnership wasn't quite right, or I wouldn't be able to quite do what I wanted to do, and I never took it. And so it was only when Bill and I have been working together at Bonner & Partners for the last few years, and this is the natural evolution of all our discussions and working together. And it was only that. I mean, he's the perfect partner. It really made me, say, well, this is the setup to do it.
Well, congratulations. I'm glad that you found that. I'm glad you found that situation. I've always been a fan of your work, and I suspect I will continue to be for a long time to come. And I'm afraid we've reached the end of our time. Boy, it goes by so fast, doesn't it? But Chris, maybe let's agree not to wait another 5 or 10 years or whatever it's been since we've spoken last.
Yeah, that sounds good.
All right, sir. Thanks very much for coming in and talking with us this week. A lot of great stuff. I know everybody will really enjoy it. And we'll talk to you again soon.
Okay, thank you, guys. Bye-bye.
Okay, folks, it's time for the mailbag. And the mailbag, the way I do it, is a frank conversation about investing between you, the listener, and me, your host. I don't have all the answers. I may have more questions than you do sometimes. But I want to hear your questions and comments, so just send in any questions or comments to feedback@investorhour.com. So let's just take a look. We just have a few of these. I'm not going to go crazy like I did it the last few weeks. The first one is from DW. And he says, your opening rant on negative skills is an interesting item. I am a fine woodworker, and when asked what I do, I usually say, quote, I take large pieces of wood and cut them up into small pieces of wood, then reassemble them back into large pieces of wood again. The trick is knowing which parts to turn into sawdust, end quote. And I'll add, and that needs to be as little sawdust as possible because I hate sweeping. That is very clever. Thank you for writing in. And he continues, if Buffett doesn't think he's paying enough taxes, nothing is stopping him from independently writing the Treasury a check for 70% of his income or capital gains. Go for it, Warren. Put your money where your mouth is. I think we may have mentioned taxes at one point, and that's why DW included that. I agree. If he wants to complain about taxes, he can always pay more. Mailbag number 2. I love this. This is by Alan M. Thank you, Alan. He starts out and says, Dan, your show gives me a tremendously relaxed feeling. I've been working at this investing game for 30 or 40 years. I consider myself a very poor investor. The only good attribute is I have never really lost a significant amount, but I have also never made many gains either, just too conservative. But I thank Stansberry for what may be a good education with a bit fuller awareness. Unfortunately, I see no way to make anything. Anyway, it's such a relief for me to hear thoughts that align with mine, that the market is substantially overvalued, and the years of central bank games just seem to have set up the world economy for a super failure because the investing public seems to have confidence in such artificial intelligence and artificial money manipulation in games. Plus, the market is up and down like crazy. I simply can't believe in the stability of the economy considering the artificial games being played, the collusion of the elite, and the political absurdity. The only thing that feels comfortable to me is gold. Alan M. Well, Alan, I think there's more to do than just gold, and I bet you're not as poor an investor as you say. I think you're being too humble because you've managed to preserve capital and sounds like make a little bit. And that's a lot better than enduring the catastrophic losses that a lot of people took 10 years ago, almost to the day, back in March of 2009, when I'm sure people were selling like crazy at the bottom. So you're doing all right, buddy. One more mailbag and then we're done. Dan, I enjoy the show each week. Really like last show and how good investment advice is also in the negative, what not to do. This is a mantra that I actually used for my success. I never had goals or plans to be something, but because I knew I didn't know everything and so didn't want to limit myself. I always did, however, know exactly what I didn't want, and so just made the choices that put more distance between me and that which I don't want. That's pretty wise stuff right there. This is by Nick P. Nick P. continues, which leads me to my point. I really like the James Grant interview, especially how he ended with companies he didn't like. Why not put a section in Extreme Value warning readers of areas or companies to avoid, especially when you don't have any new recommendations? Thanks for everything, Nick P. That's not a bad suggestion. We tacitly avoid things in Extreme Value, just by not recommending them. And I do warn you about certain things like, Facebook and most stocks being overvalued and stuff like that periodically. But we'll think about it. That might be, we only have 2 guys doing Extreme Value, so we don't want to use, we want to use our resources well. And I think searching for new ideas and warning you about risks we find is probably the best thing. And adding another feature like that might be a little bit too much time used in something that maybe isn't, that great. So that's it. That's another episode of the Stansberry Investor Hour. I do want to close by just telling you that we have a special offer for you for the Extreme Value newsletter, and you can get it by going to www.extremevalueoffer.com. These days, most of the time, I think we're getting around $1,500 for a year of Extreme Value, but this is 1 year for $999. And over the last 10 years, we just published some results. Over the last 3 years, things haven't been that great for us value investors. Over the last 10 years overall, they've been terrible for most value investors. But over the last 10 years, we've averaged 14% a year, which is pretty darn great, frankly. And if you have a true long-term horizon like that, and you don't mind underperforming for a few years, value investing is going to be your best strategy because it's a true long-term strategy that focuses on finding really good businesses trading at cheap prices and, with no debt and disclosure, some of the things that our interview guest, Chris Mayer, talked about today. And a good way to start off with Extreme Value is to take advantage of this deal and do a year for $999. ExtremeValueOffer.com is where you can find that. Okay, that's my commercial. All right, and that's the end of the episode of Stansberry Investor Hour this week. You can listen to all of our episodes, see show transcripts, and enter your email to make sure you get all the latest updates at our website, www.investorhour.com. Thanks for listening once again. I'll talk to you next week. Bye-bye.
Thank you for listening to the Stansberry Investor Hour. To access today's notes and receive notice of upcoming episodes, go to investorhour.com and enter your email. Have a question for Dan? Send him an email at feedback@investorhour.com. This broadcast is provided for entertainment purposes only and should not be considered personalized investment advice. Trading stocks and all other financial instruments involves risk. You should not make any investment decision based solely on what you hear. Stansberry Investor Hour is produced by Stansberry Research and is copyrighted by the Stansberry Radio Network.